All right, let's dive in. Today, we're going to peek behind the curtain and open up the toolkits that really power modern finance. We'll be breaking down the core frameworks used by private equity firms, lightning-fast trading bots, and quantitative investors. By the end of this, you're going to have a much clearer picture of how these sophisticated players actually see and operate in the market. So, what on earth does a private equity deal have in common with a trading algorithm and a quant portfolio? I mean, on the surface, they seem like they're from different planets, right? But there is a crucial link, a common thread that ties them all together. They all rely on rigorous, data-driven frameworks to make decisions. It's all about method over magic, replacing gut feelings with structured, repeatable processes. Okay, so here's our game plan. First, we're going to tackle the private equity playbook. Then, we'll zoom way into the logic of automated trading. From there, we'll unpack the quantitative investing arsenal. And finally, we'll tie it all together and look at the real-world hurdles they all have to clear. Let's kick things off with private equity. You know, for decades, the classic PE model was pretty simple. Buy a company using a ton of debt, hope the market goes up, and then sell it for a big profit. That was all financial engineering. But here's the thing. With interest rates higher and company prices through the roof, that old playbook just doesn't work anymore. The new game is all about operational excellence. I mean, actually getting your hands dirty and making the companies they buy better, more efficient businesses. And this number right here really tells the whole story. It shows you just how big this shift really is. A study from Simon Kucher found that a full third of PE deal teams now say that making operational improvements is their #1 way to create value. That's a huge change. Financial wizardry is taking a backseat, and good old-fashioned business management is driving the car now. This quote just nails the why behind it all. Look, when the market is going haywire, you can't just bet on the economy to bail you out. It's way too risky. So what do? You bet on the things you can actually control. Things like fixing a messy supply chain, or optimizing a company's pricing strategy, or getting the sales team to fire on all cylinders. That's execution, and it's become the absolute core of the modern private equity story. So, the framework they use to analyze all this is the leverage buyout model, the LBO. As you can see, it's a really systematic 3-step dance. First, you have to understand what everyone involved actually wants. The company being bought, the banks lending the money, and of course, your own investors. Second, you build this massive, detailed financial model to project what the company's future looks like. And third, you crunch all the numbers to answer the 2 big questions. Can this company handle all the debt we're putting on it? And will it generate the kind of returns we need? Okay, so we've been talking about decisions that play out over several years. Now we're going to do a complete 180 and zoom in, way in, to the world of automated trading. Here, the time frame isn't years, it's milliseconds. But, and this is the important part, the core principle is exactly the same. Every decision is based on a structured, data-driven approach. Now, to really get automated trading, you first have to understand a concept called market microstructure. It sounds complicated, but just think of it as the plumbing of the financial markets. It's all the nitty-gritty rules of the game, how order books work, how prices are formed tick by tick, how trades actually happen. For a trading algorithm, mastering this environment isn't just important, it's literally everything. And one of the biggest challenges in this plumbing system is dealing with things you can't even see, like hidden liquidity. This formula here looks a bit intimidating, but it's really just a simplified rule that an algorithm uses to make an educated guess. It's trying to figure out how many shares are really available to trade at a certain price, even if they're not being shown on the screen. And that's absolutely critical if you're trying to execute a huge order without tipping off the entire market. And it's super important to realize that not all algorithms are trying to do the same thing. For example, a VWAP algorithm is kind of like a sniper. Its only job is to be stealthy, to execute a big order over a long period of time, and leave the smallest footprint possible. Then you've got something like an implementation shortfall algorithm. This one is more like a bull in a china shop. It's all about speed and aggression, trying to get the best price right now, even if it makes a lot more noise in the market. So we've gone from long-term PE deals to split-second trades. Now, let's pull the camera back out and look at how quantitative investors, or quants, use these kinds of models to systematically manage entire portfolios. This is where we shift from the mechanics of a single trade to the science of building a complete investment strategy from the ground up. The central idea here is something called portfolio optimization. The best way to think about it is like you're a master chef. You've got all these different ingredients, stocks, bonds, commodities.
Your job is to find the perfect combination that gives you the best possible flavor. That's your return. Without making the dish too unhealthy, that's your risk. It's really just a mathematical search for that perfect recipe.
And as you can see, there are a lot of different recipes to choose from. You've got the classic mean variance model. It's powerful, but it's also incredibly sensitive to your assumptions. You know the saying, garbage in, garbage out. Then there's risk parity, which takes a different approach. It tries to make sure that every single asset contributes the exact same amount of risk to the total portfolio. And then there's the simplest of all, the 1/n portfolio. You just divide your money equally among everything. It ignores all data, and yet it's often shockingly hard to beat. So if these models need good inputs, where do the quants get them? Well, a huge piece of the puzzle is the idea of factors. Think of factors as broad, persistent themes that have been shown to drive returns over long periods. So instead of trying to find the next big stock, quants build portfolios that are systematically exposed to factors like value, which is just buying cheat stuff, or momentum, which is buying stuff that's already going up. And famous models like the Fama French 3-factor model provide a scientific playbook for how to hunt for these returns. Okay, so we've looked at 3 really powerful toolkits. It all sounds great on paper, right? But here comes the reality check. There is a massive difference between a clean model on a spreadsheet and the messy, chaotic reality of the market. So now we're going to talk about the universal challenges and common pitfalls that every single one of these approaches has to face. And this quote from some of the leading researchers in the field, well, it's a pretty sobering dose of reality. It is a stark warning that most of the strategies that look absolutely amazing in a historical backtest are probably wrong. The biggest takeaway here is that rigorously, honestly validating your ideas isn't just important, it's arguably the hardest and most critical part of the entire process. So what exactly goes wrong? Well, this slide lists some of the classic traps. My favorite is data snooping or overfitting. The idea is that you basically torture the data until it confesses to whatever you want it to. You keep trying different models until one looks amazing on past data. The problem is, you haven't actually found a real strategy. You've just perfectly described the random noise of the past. And the results is a strategy that looks like a work of genius in the backtest, and then proceeds to lose real money the second you turn it on. And all of this forces us to completely reframe the purpose of a backtest. Its primary goal is not to find the perfect model. Its true job is to weed out all the bad ideas. It's a filter for rejection. You should develop your hypothesis completely before you test it, not the other way around. And as the slide points out, there are much more robust ways of testing, like walk-forward analysis that are a lot harder to fool. So we've seen how private equity, automated trading, and quant investing all depend on systematic frameworks to navigate the markets. We've also seen just how brutally difficult it is to build a model that can actually survive contact with reality. But, that really is the core challenge. The world of finance is always changing, and as these tools and our understanding of their pitfalls get more and more sophisticated, there will always be new puzzles out there just waiting to be solved.